Hey everyone, welcome back to the Deep Dive. Today we're cutting through the noise to get you truly well informed on a topic that, well, it's captivated minds for decades. The unique wisdom of Warren Buffett and Charlie Munger.
Yeah, we're taking a deep dive into University of Berkshire Hathaway, 30 Years of Lessons Learned. You know the one, by Daniel Picott. And it's not just a book of insights, it's like practically a curriculum.
Absolutely. Our mission today is really to extract the core principles, maybe some surprising facts, from 30 years of their annual meetings, give you an insider's view into how two of the world's greatest investors actually think and act.
Think of it as your express pass, a really unique education sort of distilled for you.
Exactly. So let's dive in. Now, you might expect a university like this to have a traditional start, right? But Daniel Picott's journey into the world of Buffett and Munger began quite differently. He started with a philosophy degree.
Philosophy, right.
And just one economics course at Harvard. He was reading John Train's The Money Masters back in '82 that really ignited something.
Yeah, he basically declared, these investors are my professors. My curriculum is everything they say and write.
That's quite a statement.
What's truly compelling here is his sheer dedication, this self-taught education. He just devoured all of Buffett's annual letters. All of them? Yeah, even the earlier partnership letters, like before Berkshire Hathaway as we know it.
Wow.
And to attend that very first annual meeting in 1984, this was at Omaha's Joslin Art Museum, he bought a single share of Berkshire Hathaway for $2,570.
That's a serious commitment.
Yeah.
That's a significant investment in education, both time and money.
Definitely. And, he wasn't alone in maybe not fully grasping the scale of it all initially.
Oh.
His future business partner, Corey Wren, hired by Berkshire in '83, famously asked, "Berkshire what?" and "Warren who?" when offered the job.
No way.
Yes. And get this. In 1985, she actually stopped Warren Buffett and his wife Susie from entering their own meeting because she didn't recognize them and insisted on seeing tickets.
You're kidding. That perfectly illustrates the humble, sort of unpretentious beginnings, doesn't it? Before it became this global phenomenon.
It really does. And it makes you wonder, how did this informal university actually, come together?
Right.
The author really emphasizes that these annual reports, these meetings, they fundamentally transformed their core business education. He felt it easily surpassed most traditional MBA programs.
So better than an MBA.
For them, he argues, it was, without a shadow of doubt, the best investment either of them ever made. Their time and that initial share purchase.
And it's fascinating how Berkshire Hathaway itself, the company, it kind of began with an almost accidental acquisition.
The textile mill. Yeah.
Exactly. Buffett took control of this struggling New England textile firm back in 1964, not because he loved textiles.
No.
But because a negotiation over just a few pennies per share showed, well, a real lack of integrity from the seller. And that spurred him to take control. And eventually, he used it as the foundational base for all his future investments.
It really shows how character and business principles were kind of intertwined for him right from the start.
Definitely.
So if we connect this to the bigger picture, their investment approach.
Well, it started with Ben Graham's value investing, right?
The classic cigar butt approach.
Kinda, yeah. Graham focused on buying $1 of value for 50 cents, basically, finding cheap assets. But Buffett, he evolved. He realized something more profound.
Which was?
That it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The quality of the business itself became paramount.
Okay, so this is where their philosophy takes a really interesting turn then. They weren't just looking for cheap stuff anymore.
Not at all. They looked for what they called idiot-proof businesses.
Yeah, idiot-proof.
Or first liens against the passage of time. Think Coca-Cola. Its brand power, its distribution. That's like a first lien.
Meaning it's incredibly resistant to change. Or new competition. Exactly. It makes it less reliant on, say, brilliant management day-to-day to succeed. For their permanent holdings, they look for strong economics, truly able and trustworthy management.
Trustworthy, key word there.
Absolutely. And maybe most importantly, companies they genuinely liked and, crucially, understood. It wasn't just crunching numbers. It was about the fundamental nature of the business.
So understanding the business itself.
Deeply, yeah. And their approach emphasizes staying within your circle of competence.
Right.
Buffett wouldn't try picking the next software winner when he felt he had certainty about, say, the enduring appeal of a dilly bar,
He knew what he knew.
and stuck to it. They also openly dismissed diversification, called it twaddle, for those who truly know what they're doing.
Twaddle. That's pretty strong language. I mean, for most investors, diversification is like rule number one.
It is.
So how do they justify concentrating so much? Doesn't that massively increase risk?
Well, for them, it comes back to conviction and deep, deep understanding. They believe if you truly understand a business, its economics, its management, inside and out, then concentration actually allows you to fully capitalize on your best ideas.
So the risk isn't concentration itself.
No, the risk is concentrating on businesses you don't fully comprehend.
Okay, that makes sense.
And this leads to another core principle they stressed. Temperament is far more critical than raw intelligence in investing.
More important than being smart.
Much more. It's about having the emotional fortitude, the discipline to be fearful when others are greedy, and greedy when others are fearful, not trying to predict market swings.
The famous quote.
Exactly. They focus on what a business will likely do over the long term, not when the market will zig or zag.
Okay, so we've talked philosophy.
Okay.
But how do they apply that practically? When looking at a specific company, what sort of questions were they asking about its core structure?
Well, one key area they really honed in on was understanding a business's big costs.
The big cost.
Yeah. So for flight safety, a company Berkshire owns, their big cost is maintaining and updating those high-quality flight simulators.
Right.
For airlines, it's labor. Now, in a highly competitive, almost commodity business like airlines, the low-cost player, think Southwest at maybe 8 cents a seat mile compared to U.S. Air's 12 cents back then.
The low-cost one wins.
Ultimately, yes, they called this enlightened common sense, just stripping away the complexity to see the fundamental economic drivers.
Makes sense.
Yeah.
Now, a huge part of Berkshire's success has to be its capital allocation, right? The insurance float.
Oh, absolutely. The float is crucial. That's the money insurance companies collect in premiums before they have to pay out claims.
So it's like captive capital.
Essentially, yeah. It acts as captive permanent capital. It's basically an interest-free loan Berkshire can use for investments if they manage their underwriting and claims well.
And the General Reacquisition in '98, that was massive.
Huge. A $22 billion all-stock deal. It tripled Berkshire's float to over $22 billion. That was genuinely a bet the company kind of move.
But it paid off.
Enormously. It essentially created this incredibly powerful self-funding investment engine.
And this structure, having all that float, it allows them to be opportunistic buyers, doesn't it? Especially when markets get chaotic.
Precisely. During market convulsions or panics, they aim to always maintain a significant cash position, at least $10 billion, so they can play bigger than anyone and still pay when everyone else is running for the exits.
As Munger famously put it.
Why shouldn't we use our capital strength when others are frightened? Makes perfect sense, really.
Their management philosophy is also pretty unique, isn't it? Buffett saying he cheats.
Hey, yeah. He admits he cheats by acquiring companies that are already run by great managers, like IceCard, their first big non-U.S. acquisition.
So he buys the manager as much as the company.
In a way, yes. And then they keep these managers enthusiastic by letting them run their own businesses with extreme decentralized authority. Buffett even jokes it's decentralization to the point of abdication.
Just let him get on with it.
Pretty much. And this approach has yielded incredible results. Look at Geico.
Right, the insurer.
Since Berkshire took full ownership in 1995, Geico grew from about 2.5% to nearly 10% of the U.S. auto market.
Wow.
And Buffett noted each Geico policy has a sort of mathematical value, maybe $1,500, creating billions in intrinsic value that's not necessarily sitting right there on the balance sheet.
So they see value where traditional accounting might miss it.
Exactly. They understood that a loyal, recurring customer, even for something intangible like an insurance policy, generates predictable cash flow. They treat each customer relationship almost like a compounding asset. It's quite brilliant.
But they definitely don't shy away from controversy either. Clayton Homes comes to mind.
Ah, yes, the manufactured housing business. That drew some fire.
It did. But Buffett vigorously defended their lending practices. He highlighted that Clayton actually retains nearly all his mortgages.
Which, he argued, aligned their interests with the buyers. If the buyer defaults, Clayton loses too.
Right. He even tackled a specific criticism head-on, pointing out that an alleged profit figure in a critical article was actually a gross profit error, and clarified their net profit margin was much lower, around 3%. They really stood by their model there.
They did. And they also have incredibly strong, sometimes contrarian opinions on finance and accounting practices.
Like EBITDA.
Exactly. Earnings before interest, depreciation, taxes, and amortization. They've called it fraud.
Strong word again. Why?
Because they argue it paints an overly optimistic picture of a company's true profitability by ignoring real costs like depreciation, the wear and tear on assets, and interest on debt.
You can make a business look healthier than it is.
Especially capital-intensive businesses that need constant investment. Munger was even more blunt. He called creative accounting a curse to civilization, drawing direct parallels to Enron.
Wow. And derivatives.
They view derivatives as financial sewage.
Sewage, yes.
Yeah, because these complex contracts can introduce invisible leverage. A small amount of capital can control a huge underlying asset, amplifying gains and losses in ways that are often opaque, hard to track.
Leading to big risks.
Potentially huge risks, what they called a potential big denouement or collapse. They worry about systemic risk from these things.
And thinking about the broader market, their outlook, what do they generally advise?
Well, they consistently advised dampened expectations for stock returns, suggesting maybe 6-7% annually was rational long-term.
Not the double digits people got used to.
Exactly, not the 15% seen in some past speculative periods. They also believed inflation was kind of in remission, but would inevitably return. And they consistently warned about the too big to fail issue in financial institutions. They often cited, for example, the failure to effectively oversee Fannie Mae and Freddie Mac before the crisis.
So looking beyond finance, too.
Oh, yeah. They even said the most dangerous thing in the world isn't a market crash, but nuclear terrorism. It's a reminder their perspective is, well, much broader than just quarterly earnings.
It certainly is. And beyond the numbers and investments, their advice on just life and careers is equally profound, isn't it?
Absolutely. Buffett famously says, do what you enjoy the most. Work for people you admire.
Simple, but powerful.
He literally says he tap dances into work because he loves what he does. That just speaks volumes about finding genuine fulfillment.
That really is the dream, isn't it?
Yeah.
And they both constantly emphasize the importance of reading.
Constantly. Buffett devours books, annual reports, newspapers, claims he's never gotten an idea from a Wall Street report.
Interesting.
And Munger stresses reading a lot to be wise, though he adds a typical Munger caveat.
Which is?
That few who read a lot actually have the proper temperament to apply that wisdom effectively.
Ah. So it's not just consuming information.
No, it's about processing it correctly and, crucially, acting on it rationally.
And what really stands out, too, is their relentless pragmatism. Munger's algorithm for life.
Repeat what works. Brilliantly simple.
It is. They stress cultivating good habits, understanding your own strengths and weaknesses with, brutal honesty.
Yeah, and Buffett's concept of the ovarian lottery.
Right, the idea that so much depends on where and when you're born.
Exactly. It highlights the immense advantages many are just born with and the corresponding responsibility he feels to care for those less fortunate. It's a real call for humility and social responsibility.
And even their humor often makes a point, doesn't it?
Yeah.
It's not just for laughs.
Definitely not. Take Munger's dry wit when asked about succession planning.
What did he say?
He just deadpanned. We prefer to wring the last drop of good out of Warren.
Yeah.
Or Buffett joking about Harley Davidson getting customers to tattoo ads on their chests illustrating extreme brand loyalty.
Right.
Even when discussing serious topics like their own inevitable succession, they approach it with such a clear mind and honestly, a refreshing sense of levity.
It shows you can tackle complex issues without losing your perspective or your sense of humor. Yeah. Well, what an incredible deep dive that was into the University of Berkshire Hathaway.
From those surprising origins to just profound lessons in investing and, well, life itself, Buffett and Munger truly offer a unique curriculum. They really do. And they constantly remind us that the core principles of investing, really understanding a business, valuing it correctly, and crucially, having the right temperament, these things are timeless.
Yeah.
And that knowledge, when you apply it with discipline and, that enlightened common sense they talked about, it really is powerful.
Absolutely. So as you reflect on this deep dive, maybe consider this provocative thought. If knowledge truly is the most valuable asset, and if real learning comes from observing, analyzing, questioning, how might applying Buffett and Munger's ask why and think for yourself principles in your own everyday life, maybe beyond just finance, how might that create unexpected opportunities for growth and success?
That's a great question to ponder.
We hope this deep dive has given you plenty to reflect on. Thanks for joining us.